Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, November 4th, and this is the weekly market update. The disclaimer, this is not to be taken as investment advice. Anything that you hear on this podcast or video is for informational purposes only. Please do your own due diligence. It's your money. It's your responsibility. Okay, so they had the employment report yesterday. One of the things that I've been discussing for a while is the whole view that I had that the economy was basically being held up by the fact that employment was doing well, jobs were plentiful. As a matter of fact, you heard various commentators talk about how there were more jobs and job seekers, all this type of situation. And what I had suggested was that the amount of rate increases that the Fed has done in the time period that they did it was going to lead to a lag effect. It was going to take time for those rate increases to work their way through the economy and begin doing what they normally do, which is to raise borrowing costs, lower credit, cause disruptions in the economy, lead to layoffs, lead to lower business activity, the typical business cycle type stuff. And so we had not really seen a lot of effect on the employment market, but we're starting to see it now. The non-farm payrolls net change last was 150,000 new jobs. So I think what we're starting to see, and that's not the only indicator, it's not just one we just plucked off the shelf because it bolsters my particular thesis that I have. Of course, revisiting my view that, we're going to have a recession. I think it's going to be a hard landing. I think the Fed has over tightened, and they will obviously probably stay longer than they probably should on keeping rates higher for longer. That's the mantra. And so I think that eventually something in the economy will break, and that will force, whether the market goes down 30 or 40%, whether that means credit markets blow up, commercial real estate, who knows, the banks, it's unknowable right now. But then these events will then conspire to lead the Fed to having the air cover it needs to start its next cycle of liquidity expansion. That, of course, is the situation we are waiting for really thinking about entering the gold market and getting super long on hard assets. My view is that obviously I've pointed out before in a video before, excuse me, about how I have the view that gold prices are mostly driven by real interest rates. I'm not going to get back into that again, but we do need to see rates come down, and I think that's why we talk about these economic news, this economic framework that we have, and is because we're trying to think about, how long will the Fed keep rates up? Because right now we're just mostly hiding in cash. Yes, we got a few things going on, but in order to see the next cycle up in hard assets, I believe that, we need a new liquidity cycle. And as I've pointed out already, we're already seeing the shift around the world, right? I pointed out in the newsletter, in the November issue of the Actionable Intelligence Alert newsletter, talked about how I'm tracking world interest rates. We're definitely, probably since we were kind of leveling out during the summer as far as the amount of cuts versus interest rate increases at central banks. And now we've definitely rolled over where we're seeing more central banks cut rates than raise rates, and that's beginning to accelerate. So we're at the beginning stages of a new liquidity cycle around the world. Now, obviously, the bigger economies, central banks, have not begun cutting yet, but I did note in the newsletter that even since September, the ECB, Bank of England, Bank of Switzerland, and the United States are basically paused. And that's usually, an indication that the rate increases at least are over, barring some type of, massive breakout in inflation again, which I don't see happening as you see the economies, especially like in Europe, starting to roll, are definitely in recession, and ours is looking like it's going to roll. So I think that will help set the stage for later on in 2024 for the larger economies to join the rate cutting cycle. Okay, I'm having trouble with this. Okay. This is a chart. It was from Zero Hedge. I'll include the article. This is talking about Sam's rule. Caroline Sam, I think was her name. She was an economist at one of the Federal Reserve banks. But basically, I heard this on a podcast and I also saw it in an article on Zero Hedge. Typically, basically what happens is the rule is when the unemployment rate rises 0.5% within a 6-month period, it's actually a moving average, but for simplicity's sake, you can read the article and get a better explanation. When the unemployment rate rises 0.5% in 6 months, triggering Sam's rule, you have a recession countdown. So we've seen that now from the low of unemployment down here. The unemployment rate has risen to 3.9%. That's a 5% change within the 6-month time frame. And so now this is a very high probability now that we're going to be facing a recession. So I just wanted to point that out. I'll put a link to the article. You can check it out and learn more about this. This is a chart on the current cycle versus average previous cycles of unemployment from Macro Edge. You see, this is the average previous of cycles of how unemployment goes up. You're seeing that we're tracking very nicely along that now, along the average. So things are beginning to line up to indicate to us that the recession is going to happen like we thought. We thought it would happen earlier in 2020. I should say it's just me. I thought it would happen earlier in 2023, but I kind of didn't take into account all of the spending by the federal government that helped delay the inevitable. But now, we've seen that all the free money has run out for consumers from the COVID free money bonanza, and there's no more excess savings, and credit cards are now, being used to maintain a standard of living that cannot be maintained. And so now as the layoffs come, this is when we're going to see the pullback in spending. Obviously, the United States being a consumer spending based economy, it's 70-80% of the economy. If consumer spending begins to slow, then the economy will slow. So, and obviously you'll still hear, I think, the commentators on Wall Street talk mostly about a soft landing, but it will morph into a hard landing. And I guess it just depends on how you define your terms. I thought it was interesting, with this employment report that came out on Friday, and the bond market rally, the stock market rally. This is typically what you see. Don't get excited. This is what happens. But inevitably, when we have a recession, the stock market doesn't really bottom until we see well into the recession. So if you are in the new Nifty 50 or the Magnificent Seven stocks, whatever you want to call it, you really need to take a look at those charts. You really need to think about if you want to be owning those at these extended valuations, historic overvaluations going into a recession. And we've talked about that before. So David Rosenberg, pretty good economist, says today's ISM showed that a grand total of 11% of industries, 2 out of 18, posted any growth in October, the same depressed share as in the spring of 2020 and the fall of 2008. But there's no recession, right? And so if you look at manufacturing PMI, it's below 50 still. That indicates recession. It's been there for a while. I think if you look at services PMI, it's been dropping too. It's just still above, I believe, 50. It's like 51. I tracked this, but it's been slowly weakening. It goes without saying, I think that, we're heading for a recession, and I think a lot of the things now are finally lining up, and the data is going to become more certain that we are seeing heading for it or in it already. Here's some comments from Target CEO. He warns consumers are, quote, tightening up their spending. It's from the article following the warning from ex-Walmart CEO Bill Simon regarding the American consumer nearing, quote, a breaking point. Target CEO has also signaled a cutback in consumer spending, groceries included. This trend aligns with our view, as well as views from J.P. Morgan and Goldman, that consumers have hit a wall. So it's starting to line up, folks. Goes on, another snippet from the article. Pessimism extends beyond just the major retail players. Bloomberg Markets Live reporter and strategist Michael Miska pointed out this week that companies this earnings season are increasingly mentioning, quote, weak demand on earnings calls, the highest number of mentions in data going back to 2000. And so I actually saw some tweets on FinTwit that had actually graphed this out. And what it was managements on quarterly conference calls discussing this term weak demand, and it's again, as mentioned, the highest number of mentions in data going back to 2000. I mean, like I said, it's not just one data point. Everything is now starting to, it's rolling, folks. I'm happy to sit in cash right now until I see, again, I go back to using that term like they used, in the old wars back in the 1800s. Don't fire until we see the whites of their eyes. I'm not going to get tempted into firing too early. Keep the powder dry and wait for that fat pitch. I think that the Fed will run the same playbook it's always run. There's nothing new under the sun. When the market has dropped sufficiently, when I'm not sure if they'll get back to their inflation target of 2%. I doubt it, but we'll see. But I don't think that will matter. I think that in the end, they'll do what they normally do, which is initiate another round of QE and cut rates massively. But that's down the road. We haven't seen sufficient pain. They don't have enough air cover to do that yet. So this is off one of the car guy tweets. I like following the car guys. They're not only entertaining, but it's, I just have an interest in following what's going on in the automobile market, but it's a disaster also. This is Google Trends. You can go on there and you can put anything in the search box and hit it on there, and Google will tell you the interest in searches for that particular term. The term that was selected for this particular search was give car back. And, it's like, well, this goes back to 2004. These searches max out, goes between 0 and 100. I don't know exactly what that means and number of searches, whatever. It's just kind of like, I don't know, not a percent, but anyways, regardless, it's like at the highest it's ever been since this chart shows it, which is almost 20 years. So that's not good, right? That's the consumer, that took that excess savings and went out and bought that Dodge Challenger SRT, for $80,000 and now can't make the $1,200 a month payments, or the guy that went out and bought the big truck, and can't make the payments. So it's like, you got to give it back. Can't afford it. Free money, the excess savings has all been blown. Here's a tweet by Liz Ann Saunders. I wanted to put this in there. It says KBW Bank Index has wiped out all gains since September 2020. Past performance is no guarantee of future results. So I guess what I wanted to show here is that, the stocks in the bank index kind of round tripped here. And, I don't think the banks are out of the woods yet. I think that they papered it over back here. The Fed did. You had a little bump in bank stocks, but I think that the commercial real estate, the U.S. Treasury securities they hold that are underwater currently, a lot of things and then going into a recession, the default cycle will we'll go through another default cycle, and that'll put even more pressure on bank balance sheets. So I put this up here as a way to show that people are not really like stoked on banks right now, as far as buying bank stocks. And if this breaks down, what is that telling you about, the prospects for bank stocks? It's saying at least that the market thinks that it's not a good place to put your money. I've been talking about gold. I've been getting everybody ready, thinking about it. Everybody keeps wanting to ask me, when are you going to give the names out of your junior miners? When are you going to start doing this? You've talked about it. When are you going to do it? I'm not going to do it probably until next month, maybe the end of the month, maybe in the December issue. I haven't decided. Why? A couple reasons. The real interest rates that drive gold prices, they're still not have inflected and are heading towards negative rates. Again, you don't need exactly negative rates. Right now we have positive real interest rates. What you need is a change in trend. I have not seen that. That's number one. Number two, excuse me. Number two, you're coming to the end of the year. You have a phenomenon at the end of the year called tax loss selling. So what you will see is at the end of the year, people will talk to their tax advisor and they'll say, you have these gains in stock XYZ, and you have these losses in Moose Pasture gold mining stock. You should sell the Moose Pasture gold mining stock for the loss. It will help offset your capital gains taxes on XYZ Corp. This is a phenomenon that happens every year. Why is this important? Well, in the current market, we're still kind of in a bear market in a lot of these junior gold mining stocks and gold mining stocks in general. And so they don't have a lot of liquidity. And so when people are just selling to sell, they want to get out. They're not just like trying to build a position and using limit orders. They have a set amount of time they got to sell. And so people are selling stock at a loss into a market that doesn't have a lot of liquidity. It has a tendency, because of the low volumes on those stocks, it has a tendency to push the prices even further down. That's even creates more and more bargains. So that's another reason I don't want to jump in right now. I want to make my list, which I have. I think a lot of good companies, developers and junior exploration stocks that I think have good properties and good prospects that will do well during what I think is going to be a gold bull market over the next few years. So I want to wait for those bargains to come in, because that's been my experience. Why would I want to go out and buy stocks now and then have the end of the year tax loss selling come in and knock some of them down 30-40%? That makes no sense. So the list I've got my list. I'm ready to go, but I have not I'm not issuing it so that I can get everybody jazzed up and they say, well, you got me into these stocks and they're down 30%. Okay. Again, that's why I put this up here about patience and understanding markets. Remember, I'm going to be honest with you. I haven't had a lot of success with junior mining stocks. It's been hit and miss over the years. Okay. And so I want everything to line up as best I can. But I think, the time to buy them, I had not done this in the past and really focused on the gold cycle. And I think things are lining up for a move higher in the gold price based on what we're getting ready to see from a macroeconomic standpoint. So that's why I think we're, notwithstanding the fact that gold mining stocks are basically out of favor, very contrarian type situation. But I really want to set as many catalysts or many characteristics in my favor before entering the trade. And so I just want to put this Charlie Munger quote up, because this is exactly, you got to remember these things. I put the title of the slide, Learn It, Love It, Live It. His quote is, extreme patience combined with extreme decisiveness. You may call that our investment process. Yes, it's that simple. So I'm not comparing myself to Munger, obviously. I'm just trying to adopt, my thinking around the same type of view. Okay. I'm trying to be patient and wait for the exact right point to enter these trades, right? Don't want to be entering into gold stocks and gold, mining. I want to see the gold price break through into a new all-time high. We've went up here and kissed the 2000 level 3 times, okay, and then been rebuffed. And so we really need to see the gold price break through also to indicate that we have a new market move higher. We have gold breaking higher in many other currencies, like the Japanese yen, for example. And so I really don't think we really need to see interest rates, the real rate, moving in towards the negative from where it's been positive real rates and trending positive to rolling over and trending negative, heading towards negative. We need to see that. That should precipitate a move through to new highs in the gold price, get through tax loss selling, so the bargains are there, and then start loading up on those. So that's kind of what I'm thinking about on gold stocks. I mean, I guess you could just go ahead and start building the position now, but do you want to go through the volatility of tax loss selling? I'm not going to do that. I'm going to wait. Now that could change if something all of a sudden happens in the next, between now and the end of the year that overrides the tax loss selling that situation. Like you have some kind of, who knows, geopolitical thing kicks off with Iran or something like that. That every money just pours into the gold market and it just overwhelms the other calendar type based considerations like tax loss selling. So a little bit of patience, keep the powder dry, and make the list, check it twice, and get ready to, I think participate in what I think will be another run up in gold prices and a bull market in junior gold mining stocks. I will point this out. This is from U.S. Global Investors chart. They really make nice charts. I like them. But this is the central banks continue to purchase gold at blistering pace. Basically, this is the amount of tons of gold that central banks have bought. They break it down the different colors by quarter. You can see last year, over 1,000 tons of gold was purchased by central banks. We're already up near 800 tons and heading into the fourth quarter. We haven't reported, obviously, the fourth quarter. It very easily could match or exceed last year's level. This is definitely, I think a manifestation of the United States throwing its weight around and indicating to the world that we don't follow the rule of law. We'll just confiscate your assets when we think it's, when we say it's, rules-based order and all that. I don't want to get into that. And so people are saying, okay, well, I don't want to participate in that. And so I'm going to slowly but surely either let my treasury securities run off or sell them slowly but surely, and then, deposit the money in, portion of it in gold. I think that's really what's been a catalyst for these central banks to be buying gold. Especially when you look at the data and see who's doing it. China, Turkey, countries like this. It's not like France and the UK. It's typically the BRICS countries and the global East and South. So this is a chart that shows the Fed's balance sheet, at least going back to 2020. I put here Fed's desperate game of shrinkage. So you can see this is when they had the bank panic. You remember that's the little on that bank chart. That was that little blurb that we saw that they kind of recovered a little bit. It looked like a pimple on an elephant's butt. But this is when we had the Silicon Valley Bank panic. There was like 4 banks that were, and they were able to paper it over, and then they, Fed continued running off their balance sheet. So what they want to do is they want to keep rates high. They've got rates up where they are. That gives them room now to cut rates. They want to run down this balance sheet because when they have to turn this back on, this thing is going to go like this. Okay. Again, because of the way that we run our fiscal house here in the United States, this thing's just going to make, higher highs and higher lows over time. I think we're in the terminal portion of our financial self-destruction. We've crossed the event horizon. Again, I've mentioned this before. There is no constituency for cutting spending or we're not a moral people. We don't demand people that represent us to do. They're a reflection of us. We don't demand them to get their house in order. A lot of people in the U.S. don't run their own personal lives physically sound. That's why you have credit card debt at all-time highs. That's why people, when they were given the excess monies during COVID, they just went out and blew it. There's no thinking about the future. There's no time preference skewed toward the long term and delaying gratification. I'm not going to get into all that. That's not everybody, of course, but we have too many people that are like that. And like I said, these people in DC are just reflections of the population. They're not just they just didn't just show up there and take over. They were elected. People elected these people. This is what they want. And, the things that need to be done, again, are not politically possible. And the things that are politically possible are not sufficient to fix the problem. So I suspect, again, that the Fed will just go back to its old playbook. When there was a crisis, that's what they did during this banking crisis. They just turned on the printing press and there's 200 billion, poof. And then, they just, supposedly, when that particular herpes outbreak happened, they just, it kind of subsided. And then, I don't mean to be crude, but I'm trying to use a metaphor here. But then it just start letting it run off again. And that's what they're doing. And again, when we get back into another crisis, they're just going to go back to the playbook. Money printer, go burr and cut rates. It's either, turn the knob down to 0 or turn it all the way up to 10. There's not any nuance. And again, I go back to a little bit of a soapbox here. If I tell you about the story about Gazprom and how they had this huge building that took up several blocks in downtown Moscow, and it was stuffed full of 1,000 PhDs that would sit there and try to calculate by hand. There's videos about it on YouTube. All these offices, and there were 2 or 3 PhDs in each trying to calculate how much shoe polish the Soviet Union should produce every year, or how many toothbrushes should be produced. Of course, it's not possible to know. So a command economy, a centrally planned economy, we all know doesn't work. But yet, one of the biggest, most influential parts of the economy, interest rates, are being set in a similar way by a committee of PhDs based on what exactly? They're so smart. They've never been right. They very rarely have been right. They're always over tighten and over loosen, and they're always looking in the rearview mirror. They never look ahead. And so, I don't want to go down that road. It is what it is. They're not going to change the playbook. They're going to keep doing what they're doing until the whole thing. And what you're going to see over time is, your standard of living go down, more problems, because they're not going to admit they're wrong, and they're not going to change it. Too many people also benefit from this system, the way it's set up. The elites are able, if you have assets, I'm not suffering. People like me that have assets, we don't suffer. It's the working person that suffers. It's the person with no savings. It's the person that's hand to mouth. That's these inflations and economic perditions that are created, and malinvestments that are created by these central bankers. If you have assets, you're able to take advantage, and that's who those people are there to serve. So you need to understand the game for what it is, not what you want it to be. And like I said before, I've told people, you've got to put a grub stake together. You've got to put a wad together. You've got to get in the game. Going forward, like I said, we're entering the terminal stages of this empire. That means it's going to be a lot more inflation, a lot more different things that you're not used to. And if you have no assets and you can't participate in their inflations and their economic deprivations that the central bank creates and the opportunities it creates, then you are going to be out. If you're just working hand to mouth on a wage, you are out. You're going to be out of the game. You're not going to make it. Society is going to continue to bifurcate. for those that have wealth and those who don't. And the middle class is going to cease to exist. You see it on TikTok. You see it on these videos. These young people can't understand what's going on. I went to college. I did everything they told me, and I make more money as a sushi roll waitress than for my marketing degree. These people don't know what's going on. They are clueless. And it's not going to change. This whole system is set up by the elite to run for the elite. Now, you can't necessarily get a seat at the table, but if you can understand the game, you can shield yourself and take advantage. I mean, that sounds cynical. I'm sorry, but that's how things are right now in November 4th, 2023. Get yourself a wad together, learn what's going on, and prepare and take advantage of it. You'll do yourself and family a favor. So this is the last slide. You know, I've been highlighting, I don't do this out of some schadenfreude or perverse pleasure. I've talked for a long time because I am in the energy industry. I've been in it my whole life. I understand it. And I predicted, you know, I'm not taking a victory lap. I told everybody this was going to happen. You know, this is like math problems, math and science, physics, things like that. And now we're seeing it. So here's another company. It's Ørsted, which is a big offshore wind company. They got clipped for 25% the other day because they had to abandon one of their projects offshore, and they had a big charge against earnings in the billions, I think. And we're just seeing this over and over again, right? We're seeing more articles come out now. I didn't post them, but more and more the zeitgeist has changed. I called it a while ago, peak ESG. No one's going in for this. They see it for what it is. We're not going to run a modern society and world off intermittent power. Okay. And people are like, it doesn't work. Okay. And this, again, it was another top down, centrally planned idea that mostly was put in place to benefit particular industries and people in those industries, most of which have extensive lobbying efforts in DC. And that's not the way to make energy policy. But again, that's the corrupt US system. And so when it finally, you know, when you build your foundation on sand and the tide comes in and washes away the sand, this is what you get. And so this is a guy I follow on Twitter. He tweeted out here. He said, Ørsted has abandoned one of their green heists in New Jersey, and they took a big hit for it. But it's not nearly enough. They need to take their consumer fraud, their destruction, their contrived research, and every one of their criminal friends to a new planet. So that's kind of the attitude that a lot of people have. And that's getting out more and more, because when it comes down to bottom lines, the way this was sold was, we need to save the planet. We need to do this. Well, people don't see the planet being destroyed. You know, they're like, I don't see it. I don't feel it. What are you talking about? Well, now we're going into winter, so you can't sell the warming. Okay. And, you know, and the bottom line comes down to this. People are not going to pay for it. If you tell them, well, if we don't do this, we're going to have this catastrophe. And because of the ubiquity now of all of the, you know, they haven't been able to shut down information flow has went, you know, like a supernova. Twitter and all these other things, blogs. It's not like you have three networks and they all say, you know, say that, read from the same script. Yeah, they still do that, but nobody watches that crap anymore. And so people are like, wait a minute, I'll go out and look this up myself. Yeah, there's true believers. There's a certain fanaticism on each side of the political spectrum that regardless is going to advocate for this because they are true believers, but people aren't going to pay for it. And so all these developers now are coming back and saying, if you want me to do this offshore, I need more money. You need to raise rates. Like we talked about last week, one of the projects in the UK was like, well, we have to raise rates 70%. Going into massive recession with a decline in the middle class, with people kind of understanding there's something wrong, and now you want to raise my electricity prices 70% for a problem that I really can't see. You just keep saying it over and over. It's running out of steam. And so, again, this is why I am very bullish on uranium and nuclear power long term. It solves all these problems, and it will continue to solve them. And more people will wake up to that fact that the future is nuclear, small modular reactors, other technologies. And I'm not going to get into all that. We've talked about it before, but this is not like a one-off. We've been highlighting 3 or 4 of these companies. One seems like one a week, every week for the last 4 or 5 weeks is blown up now. And it's just not. I think some of these technologies have a place in certain areas. They can be useful, but you're not going to run an entire society like the United States or the EU on intermittent power. It's not physically engineering. You can't be done. If you want to, it's like the one guy I follow, Francis Menton, the Manhattan Contrarian. He said, "Where's a demonstration project in a city, state, country that we can look at and show that you are able to do this?" And they can't, because it won't work on a large scale. It can work on your homestead out in the middle of Montana, if you're off grid, or in certain locales. It makes sense where the resource is really super good. That can work. But putting solar panels on the Baltic coast of Germany, that makes no sense. Or in northern Minnesota. I mean, I don't know. The only way these are malinvestments. Putting them in Arizona or Nevada desert, that's a different story. Putting wind turbines, in Kansas where the wind blows all the time, in western Oklahoma, that's a different story. But they just can't be put anywhere. And because you're responding to a subsidy, but it's a malinvestment in many cases. And this is what's happened here, and now it's blown up. So anyway, that's it for this week, guys. Appreciate the viewership. The channel continues to grow. We thank you for that. I don't want to be one of these guys that asks you to share, like, and on every video. I would ask the people that are on the podcast, if you get this via podcast, if you could, I don't know what available you have there, to rate the podcast or add a comment, something to help the channel. I've continued on for the convenience of the podcast listeners, but I had to go to a paid service. It's not that much. I'll continue to do it, but I'm really trying to get the podcast portion of this to grow also. And if you're listening on the podcast and you have the ability, I just ask you for a favor. Do what you can to promote it. There's like likes or something on there, or you can leave a comment, and that would help with the algorithms to get this to more people. Okay, guys, that's it for this week. We'll talk to you next week. Thank you.